Welcome to our weekly Forex and Futures forecast. My name is Norris. We want to thank eSignal. I'm the Director of Education at Trading University. And we also want to remind you that trading involves risk of loss and is not suitable for all investors. The first market we're going to get back to is the Australian US dollar. Here's your daily chart of the Australian US dollar. As we said last time, the air was getting kind of thin up there. You did actually get all the way to that risk tolerance threshold level. Essentially, that's a retracement from that last isolated high there. And we know that to be a level where market makers will tend to make a stand. And in fact, they did, and they actually rebalanced things, and they got things going south. We'll see if they have another a day or two on the downside before they start to consolidate that. But no surprise, the market got to resistance. You had a pretty good run here. It would be time for correction in the Australian dollar. And as we said in the midweek report, it was a nice run up. I could see down here, coming above 92, you'd be excited about the upside, but you got up here and the air just got a little bit thin on the approach to 94 even, and sure enough, you hit resistance, and they're going to rebalance things to the downside now. So I would think that there'll be a little bit more downside involved here now. Next market will be the Euro US dollar. Euro US dollar, it's really just a sideways market, and really this market's just famous for short squeezes. Give a sell signal, get the guys short, and then run them out. Here, it's a pretty good downstroke here, but then they came all the way back, and guess what? Let's say you took that sell signal there, and you said, I'm going to stay with this through everything. This is a long-term position, and you put your stop just above there, right? Guess when they got it, they knocked it out right there. So it's a funny market to try to get short this thing. I think to get scale on it, we have to go out to a weekly, and you see that the big picture, the big pattern is still bearish. That's a pattern of lower highs we see all along. But boy, you better be good to make some hay on the short side. I think one of these days you'll go south here. Shorter term, though, I think realistically everyone's focused on the job the ECB does in defending their mandate for their currency. Their mandate is protect the buying power of our currency, and traders take that a lot more serious now than they did over the last couple of years. Overall, though, we're still interested in selling rallies against this level. I think we talked a little bit about if you manage to pop above 34. I think if you get another close above 134, you had a couple along the way. I think if you get another close on there, particularly if you had one on a weekly level, then I think it sets this market up to run up and test 137 or so. Hasn't done it yet, though. But for now, we're looking at selling rallies, and we're aware that this is a market that's essentially in a sideways range, right? From our perspective, you tend to want to stay away. From our perspective as trend traders, we tend to want to stay away from markets that are in sideways ranges, really, unless you're at one extreme. So, kind of excited about if you did get up towards the 2013 high. Make a new 2-year high, and that'd be cool to maybe make a stand with the bears up there. We'll have to see. Next market will be the pound dollar. Pound dollar rocking through resistance here. We pointed out that you had potential resistance there. That's a long-term risk tolerance threshold level. Pound had no trouble slipping through there. That would tend to be bearish dollar event, which I think may lend strength to that euro, for if the euro were to pop through those levels we were just looking at. So pound dollar, awful strong. That market's been going for some time now, and I'm a little bit surprised you didn't get some kind of weekend rebalance here against resistance. So we'll have to see there. But pound awful strong. Pound taking it to the bears right there. Next market would be dollar yen. Okay, and here's dollar yen. And we had mentioned that 3-day rebalance that the market makers, currency markets overall, kind of famous for. And there you see it. You had the 1, 2, 3. So looks like that you may have the 3-day balance going on right here. And there you go. We think overall it broke out of this big pennant formation here, and we think there'll be some more upside to it. And you can see we actually have some support levels drawn here. If it continues to back up, we'll have to see. But we still like buying dips in dollar yen short term. This is a little bit longer term chart, a daily chart here. I'll go 4-hour chart and see what there is to see. So we're keeping an eye on that level, 98 3/4 or so. Really any kind of a buy signal in here, any kind of a short term trend line break. If a bear trend line break, we'd take that as a buy signal. Let's get into the commodity markets. Well, let's cover the U.S. stock market first. U.S. stocks recovering nicely. This is a 4-hour chart recovering nicely from that late August sell-off. September, pretty strong month here. I'll go with a daily chart. You know, the story really is that, well, today typified it. You had really a tepid retail sales number. Retail sales in the U.S. was a little bit less than expected. It's positive at any rate. So, I mean, it's still impressive numbers the U.S. economy puts up, in that, you know, retail sales in August were larger than the retail sales in July. These are pretty big numbers. So things are going, but, you know, they're not. The number was a little bit less than expected, and that's really been typical of this Goldilocks recovery. You know, it's just not quite. It's not. It could be softer, but on the other hand, it's not what people would like to see. So overall, my point being, really, that's just going to continue to support the stock market, and for kind of different reasons also. Primarily that, yeah, it's not the growth we'd like to see. On the other hand, it's better than our trading partners. It's better than the other regions of the world. So, and a funny thing is here, and this is somewhat ironic, that when it does slow down a little bit, you say you have a disappointing number. Well, that opens up the door to the possibility of more QE, of lower interest rates, which tends to be supportive of the market also. So it's kind of a catch-22 in here if you're a bear. If you are a bear, you have to be a little bit disappointed that they couldn't even correct the market for 2 days or so. The market's recovering right now as we speak. It's I believe it's on the highs of the day. There you go. Yeah, it's coming right back. So U.S. stock market, can't count it out. Let's take a look at the commodity markets. We're going to look at corn, the ETF, either ETF or futures. It doesn't matter much. We're kind of enamored with this market at these levels. We think we got to watch it at 35 even in here, and we'll see. I suppose if you got a weekly close below the 2012 low, that might be significant. Starting to watch this market, thinking about the possibility of even starting to dollar cost average this market. Corn, not only it's a feed play, but it's also an energy play because it's in ethanol also. We'll have to see, though. The jury's still out. If you want a dollar cost average something, obviously the cheaper the better, right? The question is when do you start, though? Pretty close to harvest time in the U.S. That's when corn is most abundant. So, we'll hold off here and we'll see what happens. We'll see if they do take a leg down there. But I think any move lower in here would be a signal to start dollar cost averaging corn, the ETF. You buy a little bit every couple of weeks or every month or so. And then if and when corn prices swing back higher, you're in a pretty good position. So corn worth taking a look at just ahead of harvest here. The gold market, look at gold futures, and big sell-off. And as I was saying, intermediate term sell-off, I suppose it depends on the time frame you're looking at. But that trend line didn't hold. I thought it was interesting to see how it did react to that trend line. And as I was saying, in a perfect world, it would come down here and give us a double bottom. I like that idea. I like watching gold at the 1200 level. A double bottom would be, I think that'd be worth looking at. I haven't been, as I said, I haven't been enamored with gold for some time because it's been in a bear market. And you have to remember this gold, it's not an asset class market. There's no yield to it. There's certainly no interest along with it. In fact, you have to pay a carry trade. You have to pay the store gold, right? So we'll have to see what happens there. But I would be, I'm interested to see if you can get back down around those the late June, early July lows, and we'll see if you get some support there. If you did, that would be an area on the chart we might look at. I wouldn't really want a dollar cost average it, though, because if it keeps going, it keeps going. The fundamentals are going to work against that market, just because if you didn't buy this market just right, you're probably underwater. If you've been long-term accumulating gold the last couple of years, yeah, you may be underwater there. So not crazy about dollar cost averaging, but if it did get around $12 and you had a shift of momentum higher, that might be an interesting trade to look at. Next market, crude oil. Crude's kind of a funny one because international crude prices, they don't have the effect on us, particularly in the U.S., that they used to have now that the U.S. is pretty much an independent energy provider. In fact, U.S. Exports quite a lot of oil now also. So here in the U.S. and particularly in the Midwest here, gas prices aren't that bad at all. Last weekend we filled up for $3.55 a gallon, which is not bad for us, and it really, that's the same price as we were filling up back earlier in the year when crude was $10 lower. So it really not affecting us in the States, and again, that's probably something that'll benefit the dollar long term. But you could see crude oil, they're jacking that premium up. You've got the the Middle East premium in there, and this time it's I guess it's a combination of Iran and Syria now. As I was saying before, I'm surprised this market's not a lot higher actually, with all the goings on in Syria. And I would take that as a sign overall that the risk is on the downside. But the very fact that it's not going down, it's just going flat, it's a dangerous market. It's a dangerous market, no doubt about it. Here in the U.S., we tend to be, we're insulated from those higher prices for the most part because we've got plenty of oil ourselves up in the Balkan region of the U.S. If you want to see us include any markets in particular that you follow, certainly give us a call. Again, my name is Jay Norris. Thank you for watching our weekly Forex and Futures forecast.